Hi, welcome to Conquering Your Financial Future. My name's Gavin Glozier. I'm the founder and CEO of Your Wealth Hub. I'm here today with Will Hosking from PMC. Welcome, Will.
Thanks for having me, Gav.
Thank you. Yeah, good to have you here. Today we're talking about property and we're demystifying, I suppose, some of the myths that are out there in the property market. We're going to talk about renting versus buying and rent vesting, which has been a hot topic of late, particularly with the way the property market's priced. And as people kind of consider, well, should they even be buying a property at all? I think it's probably some of the areas we'll talk about. But we'll close off with a little bit about what's happening in the property market across Australia as well. And we all know that Sydney's still going gangbusters, but what's happening in the rest of the market? Surely there's some good opportunities out there. So Will, thanks for coming in today and thanks for spending some time with us. For you, mate, the property market has been at the heart of what you and PMC do for quite some time.
Yeah.
Give me a snapshot about the property market from an investor perspective. What are people really looking for when they're investing in the property market?
Yeah, well, I think... Thanks, Gav. I think one of the biggest challenges we're going to have moving forward is the fact that we're currently in a historically low interest rate environment, and as a result, particularly Sydney, Melbourne, we've seen some pretty phenomenal price appreciation over the last 3 to 4 years. As a result of that, I think we're pretty much of a firm view that Sydney is now at the top of its current growth cycle. So the challenge for investors very much moving forward is actually finding another market that might be suitable if they're happy to look outside of Sydney.
And you think that people are kind of thinking that the Sydney property market will run, or you think they're actually kind of convinced that we're probably at the peak themselves?
Yeah, I think as a buyer, because we act for buyers obviously, the property market in general, it's very, very much sentiment driven. And I think as soon as the media cotton on to the fact that we are at the top, which we genuinely believe we are, we've actually been saying to our clients probably since about the middle of last year that Sydney's been at the top of its current growth cycle. Nothing alarming, it's all very normal. Property cycles in Australia are very cyclical in nature. Typically a property cycle in Australia, history's shown us that they last somewhere between 7 to 10 years. I think moving forward cycles will probably run maybe even longer, so maybe we're looking at 10 to 12 year cycles.
Yeah.
I just don't think we'll see the price appreciation we have over the last 3 decades moving forward.
So this cycle's probably in sync with other cycles we've seen in the past, but the amount of growth we've seen has been somewhat abnormal.
Yeah, absolutely. Well, funnily enough, I think maybe we've got short memories or not, I'm not too sure, but back after the Olympics in 2000, so 2000 to 2003 or 4 was the last true, period of growth or boom we've had in Sydney. So quite similar, probably not quite as much growth. I don't know the exact statistics, but after that boom, so to 2003-4, the market virtually tracked sideways, or what we'd call stagnated, for a period of 5-6 years. I think, if I'm willing to put my neck on the line, that Sydney's probably staring down another period of stagnation, maybe 2 to 5 years.
Sure.
How long, who knows? There's some great buying opportunities now, particularly for first home buyers.
Yeah.
The lending environment's very much in favour of the first home buyer market at the moment, or home buyers in general. With principal and interest loans are at the moment, interest rates are a lot cheaper than they are with interest only loans. A lot of that's as a result of the influence APRA's had on the market.
Yeah, we heard from Phil Allen from My Debt Advisor in the last episode, and he was talking about how investors obviously are slugged with a higher interest rate, which is deterring them, reducing the yields, potential earnings that they'll earn from these properties now.
Exactly, and so then it comes back to your question around Sydney and or Melbourne, is because, again, very normal part of the cycle, because we've seen strong price appreciation. As a result, rents don't keep up with the prices, with house prices or inflation of house prices. Therefore, your yields get squeezed.
Yep.
As a result, you're carrying a lower, what we call a gross yield.
Yep.
Therefore, as an investor, you're probably carrying a larger shortfall if you're in a market like Sydney or Melbourne. Hence the reason why for some of our clients that might be cash flow sensitive, we'll look at a regional market.
Yeah.
Maybe the growth profile of a regional market isn't quite as strong as Sydney or Melbourne. However, the yield's stronger, therefore the cash flow shortfall isn't there, or it isn't as great, and it's easier to hold effectively.
Yeah, sure. So that's when we start talking about positively geared versus negatively geared properties and whatnot.
Yeah, exactly.
So let's touch on that for a moment. The term rent vesting is something that we're starting to hear a lot more on. People are renting and choosing to invest as opposed to buying the family home. Can you give me a snapshot of your take on that, and what portion, I suppose, of the market is coming through people looking to buy? Are you seeing kind of in your business?
Yeah, I think it's as a result of this affordability issue we're seeing in Sydney and Melbourne in particular. People, if they can't actually afford to buy their own home in an area they want to live, then why don't they rent and go and invest somewhere else? Which everyone's got a different risk profile, everyone's got different goals, but it seems to make a lot of sense to me for someone to entertain rent vesting. I think another reason why we're seeing quite an appetite for it, particularly the younger generations, is we're somewhat we're happy to be flexible. We're not so worried about having our sort of feet on the ground in our own home and hanging the paintings on the wall, and we're willing to try out maybe the eastern suburbs and then move to the North Shore or Northern Beaches and be flexible. That will probably change, I'd imagine, once everyone has whoever decides to have a family, because I think that's when you probably want to ground yourself at a home.
Absolutely.
But so the fact of the affordability challenge down here, and along with that, a generation or a couple of younger generations that are willing to just rent and be flexible. People are looking outside of Sydney to rent vest.
Yeah, certainly we see a lot more people come to us and say they don't want to jeopardise their lifestyle, but they want to have all the bells and whistles that kind of go with it, which means, being able to rent a property that perhaps maybe $2-3 million without the price tag that's attached to it if you happen to buy it yourself.
100%, yeah. So exactly what you've said, Gav, that typically, and it is typically, it's a bit of a generalisation, but you will be able to rent a higher value home than what you would otherwise buy. And what I mean by that is that the gross yield, so coming back to that gross yield discussion, the gross yield on a house, let's say, in Sydney, maybe round about, let's call it 3%, is the gross yield, whereas the interest you're paying on a home would be maybe high threes, 3.8, maybe 4%. In addition to that, you've got the running costs of that home as well. So you can actually rent a far better value home, potentially or most likely in a location that you desire, and then go and rent invest somewhere else, rent vest.
Okay, so let's talk about investing in property just for a moment. If anyone's listening and they're thinking, well, what constitutes a good property? What are some of the facets of a property that you must have to constitute a good investment? What would be some of the kind of tips you'd give us?
Yeah, I always say I think property is an asset class that we all assimilate with or we all relate to, particularly in Australia. And as a result of technology and the amount of information we've got at our fingertips, I think we can actually be guilty of over-sciencing property. It really comes down to, and I sort of probably laboriously repeat this with clients, that it comes down to the fundamentals of supply and demand. So whether you're entertaining a house or a unit, whether you're looking in Sydney or it might be Toowoomba or Perth or Adelaide, no matter what market, you need to get the fundamentals right of the area you're looking in. So making sure that it's in an area where you've got as much demand as possible. So what comes with demand is population pressures, employment, etc., and as little supply as possible. So when you have areas where there's a lot of supply coming on the market, and it might be, for example, I think the medium to high density unit market in Brisbane and Melbourne and certain pockets of Sydney is oversupplied. Therefore, the demand can't keep up with the supply. Therefore, prices will stagnate or maybe even potentially come back. If you're in an area where there's scarcity of the asset type you're trying to buy, there's a lot of demand on it, but no more supply, prices have to go up.
So in its simplest form, it is supply and demand that constitutes a good property. What about things like facilities, public transport, like the really nice to have, which are almost kind of necessities, I suppose, in this environment, particularly in congested cities? Yeah,
we've got our own internal investment grading process we go through, and it's very much sort of a macro to micro approach. So looking at the macro state, employment, location, then down to suburb, then maybe even down to pockets in the suburban street. Proximity to transport, amenity, critically important. I think walking distance to some form of transport's a must, whether that's bus, train, ferry, whatever the case might be. Then you get down to the actual asset itself. So, looking at certain things like floor plan, flow, aspect, levels of natural light, bedroom sizes, etc. You really want to focus on an asset, once you get down to the sort of the micro level, an asset that has as broader appeal to the market as possible, and particularly owner-occupier appeal. Because at the end of the day, from our experience, your owner-occs are typically the ones that will pay with emotion, pay with their heart, they fall in love with the property. If the market flattens or stagnates, investors can sell. They've already got a roof over their head, potentially.
Yeah, okay. So if you can tick as many of those boxes as you can, A, you're going to get the capital growth, and secondly, you're going to get a great yield as well, because there'll be strong demand for it.
Yeah, and vacancy. Vacancy, exactly. So they're the three sort of, I guess, key things an investor will be looking for. Capital appreciation, good yields. Yields are a bit different. Every client's slightly different in terms of their yield appetite. Some on higher incomes are happy to negatively gear. But one of the biggest, I think, risks we see, or concerns, I should say, that investors have is vacancy. They say, well, I need the security to know that if I buy this home, I can get the tenant in there to help pay for the mortgage. Vacancy is really important. 3% vacancy in the residential market is what we consider to be an equilibrium. Anything below 3 is good. The lower, the better. But one thing I'd say to anyone looking to invest is that as long as you actually listen to your property manager and listen to the market, you actually shouldn't experience vacancy, or very little vacancy.
Sure.
We've got an asset management division to our business, and we look after about 400 odd of our clients' properties. So we've got a lot of experience in that side. When we see clients with vacancy, it's typically when they're not listening to their property manager or the market, and they say, well, I got 500 last year, I want to get 510 this year, 520 next year. It doesn't work like that. The rental market's no different to the property market. It's cyclical.
So it is about listening to the experts, which sounds so silly, but that's really what you're saying. Okay.
And be willing, if you're at $500 one year, and I've had this experience myself with my own portfolio, I might have to drop my rent back down to $480 to secure a tenant. But for $20 a week over 52 weeks of the year, if you sit there at $500 for 4 weeks vacancy, it's not worth it. You're just better off adjusting to the market.
Yeah. Okay. Look, I wanted to talk to you about different TV shows that are out there that kind of, I think, create this false sense of awareness of what the actual property market's actually doing. So shows like The Block, shows like Renovation Rescue, they show people coming in, doing getting all this money, tidying up the property, so to speak, and selling it and making a lot of money. And I think there's a lot of people that kind of head around and they think, I'm just going to buy this place, flip it in 18 months or even less time, and make a killing. Is that realistic? Is that even a fair assumption?
I think the hardest thing, I probably would say no, it's not realistic. The people that have the best opportunity to do that type of thing are a builder, someone who's actually a builder themselves, so they don't have to charge out their hours or they get wholesale prices. I think shows like The Block give people a false sense of hope. The biggest challenge with doing what we call a flip strategy in the property space, property as an asset class actually is quite expensive to enter and exit. So you have to pay stamp duties, solicitors' fees, building and pets, etc. So your entry cost might be anywhere in the vicinity of 5 to 8% to get in. And then your exit costs, you're paying selling agents' fees, solicitors' fees. Hopefully you've made a capital gain. So if you have made a capital gain, you'll pay some capital gains tax as well. So after you wash out all your costs, it's actually really challenging to make a good profit. If that's not your line of work, if you're not a builder or you don't have cousins, relatives that are builders, I'd say stick to what you know and stick to more of a buy and hold strategy. I think even if you want to do a renovation, I've just personally done one myself with a property in Newcastle, and I'll admit it, I actually set a budget and we've gone over budget, and it's my profession. It's really hard to stick to your costs. It's really easy to blow out. I think if you are going to renovate, do it to kick up yield, do it to kick up equity, and then still hold for the long term.
Okay, so looking for capital growth, capital improvement, and obviously increased yield as a result of that renovation.
And then you can get some depreciation as well. One of the big changes that have come out recently by the government is that if you actually pay for the fixtures and fittings yourself, you can claim the depreciation. So by doing a renovation, you can actually increase your depreciation as well, which assists with your cash flow.
And becomes all tax effective at the same time, which is what you want. So we'll kind of move on to the property market itself, and the question that we see from time to time, and I think it's questioned more now because people are uncertain. They hear the media hype about what's happening in the property bubble, particularly in Sydney. Is now a good time to buy, and what areas would you be looking at if you're still looking to get capital growth outside of capital cities, which we hear about all the time?
Yeah, look, I'll be honest, I actually think anyone particularly that's come from Sydney and again Melbourne to a degree that's expecting to see the same sort of performance outside of Sydney will be disappointed. So it's actually getting everyone's expectations right from the outset. The reason we love property as an asset class is because of the leverage component, and I mean responsible leverage, and the power of compound growth. So when you're putting your own, whether it be cash or equity against another property down as a deposit, and let's call it maybe 20% deposit and you're borrowing 80%, you're actually getting 100% upside in the property, even though you've only put 20% down. So from a growth perspective, you actually only really need to get conservatively, let's call it 5 to 7%, 5 to 6% capital appreciation per annum to actually get a very, very nice return on your capital or your equity. So don't be scared of markets having a more modest growth profile than Sydney's just had, because I don't think there'll be a market that'll do what Sydney's done.
As I said, it's abnormal. It's abnormal to the type of growth we've had for the sustained period.
Yeah, and Sydney, again, looking back to its last period of growth after the Olympics, it tends to be, for whatever reason, it has its steep spikes and then it stagnates and then it goes again. Whereas you'll have maybe a regional market that's just a steady performer. So there are definitely opportunities outside of Sydney. I think people have to be really careful, particularly the asset type. Again, coming back to supply and demand. So if you're considering units up and down the east coast of Australia, be really cautious of where you're buying, making sure there's not a lot of supply coming on in that area that you're buying. But yeah, there's 5 markets we're buying in outside of Sydney. We're currently looking at Perth, for argument's sake. I think Perth's at the bottom of its growth cycle. There's a lot of commentary around that. I believe it genuinely is. The challenge we'll have with Perth is it's quite heavily reliant on the resources sector. How long will that state economy track along the bottom until we start to see that market rise? So we analysed the top sort of 18 most populated metropolitan areas in the country, because they typically have the best performance from an industry perspective, population perspective, etc. The one thing I always say to clients is there's actually always opportunity in property, because there's no one market in Australia.
That's interesting. You mentioned there Perth. I know we've talked before about Newcastle, particular pockets in Newcastle are good. What are the other 3 that you mentioned that you're looking at the moment?
Yeah, Brisbane, we're doing a bit of buying in Brisbane, quite a bit of buying in Brisbane, but cautiously only freestanding assets, because our professional view is that the unit market's going to have, or it does actually have, supply issues at the moment. So predominantly freestanding houses, they're performing reasonably well. I think there's some good data that's come out of Queensland or Brisbane in the last quarter, which is encouraging. Toowoomba's a nice little regional market that we're buying in. That's a bit more appropriate for a client that might be have some capital restrictions or not want to jump in too deep. So, around that sort of 400 to 500 mark. Really nice yields. Again, the growth profile might be slightly reduced in a market like Toowoomba, being a second, what we call a regional. However, because of the yield aspect, it's not actually costing a client to hold it.
Strong,
Redcliffe Peninsula, Newcastle. I really like Newcastle long term. I think it's a great market. Probably the only disclaimer I'd have on that market at the moment is I think it's shadowing Sydney to a degree. I wouldn't be surprised if it reaches its peak in the next sort of 12 months or so. But long term, there's just such a buzz going up there in terms of infrastructure spend, employment, 10-year outlook. I think it's a great looking market.
I saw a report recently talking about how Newcastle's actually picking up a lot of the population growth that Gold Coast was getting as well. So there's a lot happening, a lot of people moving there, which is interesting.
Doesn't surprise me. It's got a lot of appeal. I mean, it's got obviously Port Stephens to the north, Lake Macquarie to the south, the beaches on the east. It's got the Hunter, wineries, etc. From a lifestyle perspective, it's amazing. And I think what I believe will occur, I've got family in Newcastle, is that after the last boom in Sydney, we actually saw interstate migration to Queensland and southeast Queensland increase significantly from an affordability perspective. I think Newcastle's actually provides a great alternative, if not better, because if you're leaving family behind or friends in Sydney, you're a 2-hour commute, so you don't have to go and line up at an airport, book a flight, and the costs associated. So similar to the likes of Wollongong, I think people can still come back and see family and friends in Sydney, but it's more cost effective and still got amazing lifestyle factors.
Great. Well, thank you for your time. We're out of time, unfortunately, but some great tips there. In terms of looking at what to look for when you're buying a property. Look for places with strong demand, low supply, good employment, strong facilities as a means for investment. Pockets you're looking at were Toowoomba, I think Redcliffe and to the north of Brisbane, and areas within Newcastle and Perth as well, and Brisbane City. So there's a lot actually going on. Thanks so much for your time, Will.
My pleasure.
Really appreciate it. I hope you enjoyed the third episode of Conquering Your Financial Future. My name's Gavin Glosey. I look forward to seeing you in our next podcast. Thanks a lot.
Thank you.
Good work, mate.
Yeah.
That was good.
Yeah, cheers.
Yeah.